Howdy, Jacob here. Today we're looking at Brady Corporation in the commercial services and supplies industry. 3.1 billion market cap, slightly lower enterprise value. They manufacture and supply identification solutions and workplace safety products to identify and protect premises, products, people in the U.S. and internationally. Founded in 1914. It's been around for quite some time here, and we do see that on the revenue side. Not a lot of growth here, at least in the last 10 years, but the last 3 years have been promising. Gross margin, very impressive, almost 50%, very consistent. Operating margin in the double digit, mid teens, that's very promising as well. Dividend, they pay a dividend, 92 cents a share, quite a bit lower than their earnings per share, so the payout is pretty reasonable on the earnings side. We'll see on the free cash flow side shortly. And return on invested capital and assets above 10%. Return on invested capital in the mid-teens, very likely well above their weighted average cost of capital. Creating business, that's a great sign. Balance sheet shows 152 million cash on hand with no short-term debt, 50 million long-term debt. We're very comfortable with this. No worry on the balance sheet whatsoever. Free cash flow statement reducing or capital expenditures are down from 10 years ago with over double cash from operations. So they're really pushing free cash flow here. And there was an acquisition in 2021, net acquisition of 244 million. Otherwise, they're really just giving money back to the shareholders. You, as a shareholder owning this business, they're giving it back to you by buying back shares that are hopefully really cheap. But anyways, they're buying back shares, so reducing the share count. You own a bigger piece of the pie, and then giving you money as a dividend. And the great thing about buying back shares while paying a dividend is that if you were to buy back 1% of shares, then your aggregate dividend goes down if you pay the same amount. If you pay 10 cents a share, there's less shares out there outstanding, so it'll be less on an aggregate basis. And so, I mean, all that is fairly positive. I mean, it doesn't look like we're going to have a lot of growth here, but that's not a problem when you're really giving money back to the shareholders. You can still have a fantastic investment. And so on the revenue side, I'll probably be on the side of a bit cautious, maybe 2%. And then, I mean, with those type of margins and with operating margin increase, they might have not a moat, but some sort of advantage. So I might be comfortable with a 14p in price free cash flow at the end of 7 years, saying that it is below the market, but their growth is definitely below the market. Or maybe they have something that other businesses just can't quite compete with. So maybe let's do 11 and 12 on the P and price to free cash flow. With buying back shares, 1% is about 30 million, 3% is about 90 million, 2% 68. Let's keep that. So about 60 million. That would be a little over 50, just under 50% of their 5-year average free cash flow. Pretty comfortable with that. The dividend of 45 million is paying out well below that. So let's increase that. Yeah, let's increase that 1% a year so that they can say that they're dividend kings or whatever the heck that phrase is. But even still, with those assumptions, it does look a little pricey. And again, that's due to the fact that your revenue is really not going to be growing a whole lot. And so, for this to really be a fantastic investment, the company would have to be buying back really cheap shares. And for that to happen, the company's stock price would have to decline more for them to buy back shares at a 7, 8, 9p. And then at that price point, they can maybe buy back 5 to 6% of shares a year and really start, giving you more ownership of the business, which is going to very likely increase the price of the stock, all else equal, because the market cap should stay the same no matter the shares outstanding. So, I mean, right now, I think it's a fine business. I think that they're really giving money back to the shareholders, but to me, it's not so obviously priced given the fact that their growth rate is just not astronomical. So, if you enjoy the video, have a great day. Thank you.